Yesterday, I got a question about how to identify trends, market structure, and the overall flow and the momentum of the price. So I decided to make a very quick video talking about these exact subjects. Honestly, it's not that hard to see what is actually happening with the price. As a trader, especially if you're a day trader, you always want to follow the momentum and the general price flow instead of trying to catch a reversal. Trying to trade against momentum usually makes things much harder than they need to be. And identifying the current momentum is really not that difficult once you know what to look for. One of the biggest things to focus on is the previous higher time frame high points. If those high points keep getting broken, it is usually means the price flow is moving upwards. And if these major low points are being protected and not getting taken out, that already tells you a lot. At that point, you are starting to see the full story of the market is giving you. So, what exactly is that story telling us? If the price is moving from one point to a higher point, first of all, that shows the strength and power from the buyers. When this is happening and the old highs keep getting broken, it clearly means you have a trend in the place. And if the most of the lows are being protected and the price is not even touching them, this is another strong buyer protection signal. So once you have a clear high time frame flow and a solid trend confirmation, all you really need to do next is focus on the lower time frames. Basically, what you want to do is apply the same exact idea on the lower time frames, like old highs getting broken and the price continuing to make new highs, while price is also moving up on the lower time frame. So this way, you are confirming both the higher and lower time frames and keeping them in harmony with each other. At the end of the day, it doesn't really matter because price is generally either crashing or rallying anyway. If price is rallying, you want to wait for a strong and clear breaks to upside. And if the price is crashing, you would want to wait for a strong and clear breaks to the downside. After that, the next step is simply to follow the exact same process again on the lower time frames. So what you are doing here is combining the higher and lower time frames into the same flow and the same trend and the same overall direction. By doing this, you naturally increase your probability and your overall statistics of taking winning trades. For example, if you look at Bitcoin over the last couple of weeks, what you see here is actually pretty simple. Price was taking a significant loss to the downside, and it was crashing from around 95k down towards the 70 and 60k. So there is a clear price decline happening here. And when I do this, I'm not obsessed with exact lows at all. I'm simply looking at whether the major lows on this chart are getting taken out or not. While all of this happening, if you look at the high points, you can see that generally they are being protected. Now here is my question, and it's a very simple one. Who has a better chance of winning right now on this chart? The short traders or the long traders? Which side clearly has the better odds and probability at this moment? I think the answer is pretty obvious here. If the price is crashing, making new lower lows while the highs are still being protected, it makes much more sense to look for a short trades instead of long trades. This is not an opinion at all, it is simply based on statistics and probability in the data. So when you drop down to the lower time frames, you follow the exact same idea here. You wait for the lower time structure to shift downward as well. To avoid fake moves and false signals, you may want to wait for a couple of breaks to the downside instead of a single break. Ideally, you want to see 2 or 3 clear breaks of the structure moving downwards. By doing this, you are confirming two important things here. You are confirming that the high time frame and the low time frame structures are both strong and moving together. When the flow is aligned and moving in sync in the same direction, This will dramatically increase your chances of winning trades. I heard that some of you having trouble trading ongoing rallies, whether it is in cryptocurrencies, gold, silver, or the Nasdaq, or any other asset classes out there. First of all, what does a rally really mean? Understanding the structure of a rally is actually not that hard once you break it down in simpler terms. What you usually see is multiple green candles printing consistently, with price pushing higher and higher over time. And most of the time, we notice this clearly on the hourly charts, like the 1 hour, 2 hour, 3 hour, or 4 hour time frames. So, what you should be checking is whether the price keeps taking out previous highs and making new higher highs on those hourly charts. That kind of price action clearly shows the strength coming from buyers in the market. But that alone is not enough to confirm good and healthy rally. Second, you also need to check the low points of the candles and see if they are mostly being protected or not. If the lows are holding and not breaking down, that tells you that sellers are not strong enough to create multiple lower lows to push the price down. So overall, what you are really looking here for is a strong increase in price within a short period of time. I am talking about an asset that can move 10, 20, or even 30% in a single day. For example, if you look at this specific cryptocurrency, after a period of price accumulation, it did break out and rally significantly started in a single day. Then you will notice that old highs keep getting taken out by buyers as the price continues to pushing up. At the same time, the old lows are mostly protected, so sellers unable to push the price back down. And overall price moved from $150 to $200 just in a single day, which is about a 30% gain. This is where most people make a big mistake. They try to focus on exactly where and when the rally starts. And believe me, it is extremely hard to consistently catch the exact beginning of a rally in any asset classes. So do not focus all your energy on trying to predict when the rally is going to start. Instead, focus on the rally that is already in progress. An ongoing rally is much easier to recognize, and it is much easier to trade with confidence. Now, let's drop down to the 5-minute or 15-minute charts from the hourly charts and really think through what we should be doing here. Remember, you are not trying to guess exactly where the rally is going to start from the very bottom. Instead, you are simply trying to join an ongoing rally as a trader and ride the move that is already happening in real time. Your first step should be pointing out the significant high points on the 5 minutes or 15-minute charts. Just mark them clearly as they happen and keep your focus on those levels. Once those highs get broken, you need to ask yourself one simple question. Is there a pullback happening after any significant breaks? And remember, not every single breakout will give you a clean pullback to enter. For example, right here there is no pullback at all. Price just keeps rallying straight up without giving any real enter opportunity. But if you look at a little higher on the chart, there is a clear significant pullback that gives you a chance to enter. And if you are looking at our rally on the real charts, you will notice that one of the recent high was broken very strongly. And there was no pullback at all to give you a safe or clean entry here. However, if you just focus on the prior high point instead, once that level is broken, you can see a strong pullback area forming. Inside that pullback, there are inner imbalances that give you a solid place to enter a trade. So trading rally is really just about joining the ongoing move and the strength behind it. You are simply trading with the momentum and going with the overall trend here. It has been clearly proven over time that trading with the force and the trend is much easier, and it is usually gives you a much higher win rate compared to trying to trade against the momentum. Let's talk about how you can improve your trading game in a smart and practical way. I want to focus on finding trades in a very specific zones where price is more likely to react. As you already know, support and resistance flip areas are one of the core trading methods out there, and they are used by millions of traders around the world. So basically what happens here is that a strong old support area that has been holding the price for a while suddenly gets broken. Then the price starts to move back up toward that old support area. And what we expect at that point is for that old support to act as a new resistance. This is usually where we step in and play our game around these multi-imbalance trading locations. Now here is an interesting question to think about it. During the pullback, if the inner structure is bullish while price is moving towards the support and resistance flip location, can we take small scalp longs? And yes, the answer is absolutely yes. What we are doing in this situation is trading a counter trend, basically looking for a small reversal using the inner bullish structure. Is it riskier than usual? Yes, it is, because you are trading against the main higher time frame here. But it can still be usable sometimes, especially if you don't see any other clean setup in the market. However, the main trade idea still sits around the support and resistance flip line. What we really want to see is strong rejection candles forming around the SR flip and the multi-imbalance area. And more importantly, that rejection should be followed by a clear structural change. That means the inner trend should be also shift from uptrend into a downtrend. But most of the time, that first market structure break can be tricky. There can be a lot of fake moves and false breaks in the beginning area. So if you want to more secure and higher quality trades, it can be smart to wait one or two more structure breaks forming the clear downtrend here. As you can see, what you are really doing here is playing the both sides of the game. You take the riskier longs during the pullback, and then you focus on better, higher quality shorts once everything lines up. Now let's take a look at a couple of real examples directly on the charts. What you're looking at right now is the hourly chart. The hourly chart is a great starting point to understand the current price action and the overall direction of the market. Notice how the recent price created this extremely large imbalance location, then pushed back into it, and after that it completely crashed down. As you can see, this move happened right inside a significant support and resistance flip location. It was a strong old support level that later turned into a resistance area. And right here at that level, you can clearly see a nice swing failure pattern forming. So everything is lining up together here, including multi-imbalances, multi-swing failures, and SR flip location on the higher time frame. Now I'm going to drop down to the 5-minute time frame to see what is happening inside the inner structure, the low time frame structure. First of all, you can see that at some point there was a bullish run that got created. We had the first market structure break, followed by another break of structure moving towards the multi-imbalance and SR flip location. However, the moment price tapped into our higher time frame concepts, the inner trend shifted once again. We then created a bearish market structure break, which clearly shows that the sellers are stepping in and taking the control back. And here is the important tip that you need to remember. If you struggle with using market structure breaks, then simply wait. Wait for the next clear break of structures to form. Let the downtrend become more obvious and more structured before you make a trading decision. And then, as the price starts dropping aggressively, you can use different methods to enter a short position here. For example, you can use inner imbalances or maybe build small average costs entries in the area to help to push the trade further to downside, especially using my yo-yo style dollar cost averaging methods. Recently, I got a question about order blocks, so I decided to make a quick and simple video explaining how to identify clean order blocks and how to trade them right away. Order blocks by nature are not very complicated once you really break them down and understand the basic idea. So it's basically the opposite color of consecutive candles in a row that appear right before major breaks in structure or strong trend reversals. For example, during an upward rally, the last two red candles before the strong move up can define a demand order block here. On the other hand, before a major crash with an internal break of structure, the last two green candles can define a supply order block. Now, if you really want to make order blocks more effective and more reliable, it is best to combine them with imbalances. So when you look at this price action, right here, what we are seeing is a combination of order blocks, imbalances, and structural breaks all working together. When all these elements line up at the same time, they create a very powerful setup that many traders call dragon fruit combination. Especially when you look at earlier parts of the chart across any assets, you will notice there are many order blocks forming all over the place. Naturally, this concept does not work every single time, and it is important to understand that. However, when it does work, it usually leads to strong and aggressive price movements. If you look at this chart right here, you can clearly see a clean supply order block in this area. It is also combined with a large imbalance zone that formed right after a structural break. Notice how the crash actually started from the exact order block area. And if you shift your focus to the right side of the chart, you can see a strong move up that came after the combination of imbalance, break, and the demand order block this time. That combination is what started the massive rally and pushed the price sharply higher. However, if everything were really that easy, then everyone would be making money in the markets. And of course, that's not the case at all. There's absolutely nothing easy about trading, I assure you that, especially when the real money is on the line. First of all, you will probably notice that half of the order blocks get completely destroyed without any reaction from the price. In many situations, price simply comes into the zone and keeps crashing straight through, and the demand area never holds at all. And that is exactly why it's so important to pay close attention to the lower time frames. Basically, when you identify an hourly order blocks like 1, 2, 3 hour order blocks, you also need to check the minute-based inner structure before making any decisions. If the inner structure trend actually shifts inside your demand area or supply area around that order block zone, that is when things start to look more interesting. For example, let's take a look at this crash area with the supply order block combined with an imbalance and the inner break. Like I said, there's no guaranteed rule out there that says supply and demand order blocks will always hold. As you can see, price in this case could easily rally higher to take out offers without any hesitation. We simply do not know in advance what price is going to do next. It is impossible. But if you carefully and study inner structure, you can see the market structure shift followed by internal break of structures here. So in this situation, the higher time frames and the lower time frames are now aligned together. So what does all this really mean for you as a trader? Basically, when you identify hourly order blocks, whether it is on the 1, 2, 3, or 4 hour charts, it does not matter if they are supply or demand blocks. You then need to drop down to the lower time frames, especially minute-based charts, and check what is happening at your entry location. You want to see if the inner structure is actually changing and whether the supply or demand area is truly holding or just failing. When you combine these two different time frames together in a smarter way, You give yourself a much better chance of getting stronger and better results in your overall trading journey. Breaker blocks come up often, so I want to do a quick recap and show how you can find some of the best ones directly in the price action. In reality, breaker blocks are not that complex concepts at all. Quite the opposite, they are actually a very simple price action idea. A bullish breaker block is generally the last consecutive bullish candles before a trend reversal to the other side. For example, in this chart, the final bullish candles before the market reverses upward becomes our bullish breaker block. It's that simple. Interestingly, breaker blocks are basically just support and resistance flips. Once you see them this way, identifying them becomes much easier. When you combine breaker blocks with internal imbalances, you start to build a very powerful smart money framework here. Let's look at this example. Notice two consecutive bullish candles. This area becomes our breaker block. Why? Because this is the zone where the market broke structure upward and the previous downtrend transitioned into a bullish trend, a reversal here. It also happens to occur at a natural support and resistance flip location as well, which strengthens the setup. In fact, some of the most SR flips can be potentially act as a breaker block areas. So this raises an interesting question. Can you build a single time frame setup based purely on higher time frame structures just like this one? For example, a simple 2-hour compact setup? The answer is yes. While it won't work every single time, it can be a practical approach for traders who prefer a simpler process and don't have time to monitor multiple time frames and so much free time on their hands. However, if we want better results in our trading journey, we need to look at combination of multiple time frames. For example, you might find your breaker blocks on higher time frames charts first. Then you can move down to the lower time frames such as minute-based charts to observe the inner trend and the market structure. By doing this, you are essentially combining higher and lower time trends to determine a trade direction that can be far more reliable than relying on a single time frame. Now, if we go back to our example and this time move down to the 15-minute time frame, you will notice something interesting. Inside the higher time frame breaker block area, we can see an inner break of structure along with an imbalance on the lower time frames. What this means is that the higher and lower time frames are now aligned. Both are showing a bullish trend upwards. So in this example, our first setup was based purely on a higher time frame analysis using the hourly charts. But our second setup combines both higher and lower time frames, essentially using the hourly chart for context and lower time frames for confirmation entry. If you trade using only higher time frame setups, there are actually some benefits there. You will find setups more quickly, and it is generally easier to identify potential entries. However, there is also a downside. Price action can become quite unpredictable because a pullback might continue much longer than expected, since you never confirm the entry with lower time frame structures. On the other side, when you combine both higher and lower time frames and align the trends together in both time frames, you can achieve better trade accuracy. But this approach introduces another challenge: waiting time. You may need to wait for hours for the lower time frame confirmation entry, which is significantly longer compared to trading a single time frame. As you can see, every trading approach comes with its own advantages and disadvantages. So ultimately, the way you trade should depend on your availability and your daily schedule in life. I was getting a lot of questions about liquidity and how to really understand it and actually master it in trading. So I decided to make a video that is 100% focused on the liquidity and nothing else. First of all, in my opinion, finding and understanding liquidity areas depends heavily on the current trend and the overall momentum. As you know, I'm a big fan of following the general trend and when it comes to trading in the markets. The first thing you should always want to look for is price taking out the prior old highs or not. Because this is a big sign of strength, clear trend direction, and real power in the markets. Naturally, traders like all of us want to follow the trend and keep entering trades with the same momentum. However, as more traders enter, the number of positions keep increasing. This creates a lot of open stop losses in the market. Over time, you will start to notice a pool of stop losses building up around certain specific price levels. This is a moment when liquidity pools are created in the market. These areas usually consist of thousands of stop losses sitting in the same zone from traders all around the world. At some point, those stop losses are usually swept, and then the general trend continues to flow in the main direction again. It does not matter whether the market is rallying or crashing. The core idea stays the same in every market condition. As traders, we like to follow momentum and trade in the direction of the overall trend. This is because statistically, following the trend tends to make more money than trying to trade against it. But that does not mean we can enter trades at just any random point. We need to be aware of liquidity pools where thousands of stop losses are stacked and gathering in specific areas. We also need to understand that liquidity pools can be created and swept at any moment. As I said before, following the prior highs and lows and knowing which side is getting taken out is critical for understanding the trends. The problem is that no trend or momentum lasts in the same direction forever. At some point, even if you see a liquidity pool get swept, it does not automatically mean the trend will continue. After that, you may start to notice internal breaks forming in the opposite direction after or with a major break. So this can often be the point where the trend reversal begins. So let's look at this example. On this chart, you can see a big major break that was taken out earlier. Many traders want to follow the direction of new upward move, which is a very natural reaction. However, all of these newly opened trades, sometimes thousands of them from all over the world, creates a heavy concentration of stop loss orders in the similar price levels as you can see. In many cases, this behavior is followed by a large and deep liquidity sweeps. After that, the price action often shows internal breaks again, leading to a second, third, or even fourth of the main rally. So as you can see, understanding liquidity and where it gathers is extremely important. Using this information in the direction of the trend can be a strong and effective strategy for most traders out there. A couple of months ago, I posted a tweet like this saying this was the most critical weekly imbalance area. And I said that if we couldn't break through it and push over 100K, there could be possible crashes here. And since then, Bitcoin crashed just like I predicted. So how do you make this kind of predictions and invest in the markets at the right times? Before we even start, we need to talk about why prices get expensive over time and when the best times to invest really are. Every type of assets gets more and more expensive during the rallying periods. At some point, prices hit all-time highs and become overextended with extreme pricing. The way I generally invest is quite simple. I like prices to crash. And honestly, I love when the other people cry and scream during those crashes in the social media. Those are the best times for me. That's when I slowly invest my money using small, periodic entries, usually on a weekly basis. Remember when we hit the 120K area? If you open social media during that time, everyone was saying Bitcoin was going to 200K, 500K, and even some said $1 million soon. Everyone on social media said it was the best time to buy. However, since then, the price crashed around 30% in just 3 months. So my general investing or swing trading idea again is quite simple. I take profits. When the prices hit all-time highs or become overextended, or when I see my positions are showing nice green gains. Great time to take profit. This is usually the time when the social media tells you it is best time to buy and people get more and more greedy. But in my opinion, the best time to buy anything in the world when the prices are cheaper or crashing. When I see deeper pullbacks, that's when I like to invest. Especially when I look at social media and everyone is crying, screaming like Bitcoin is gonna be $1 and fear is everywhere. Those are the best times for me to buy and wait it out. If you look at the markets yesterday, you saw an incredible price move in the silver. Everyone was screaming that it was a great time to buy silver. There was this global tension and people were saying we are going to the 200 levels. Best time to invest. Yeah, sure. Then the price crashed, but crashed like nothing else before. The silver price dropped like 40% in a single day, in a one day. It was one of the biggest manipulations I ever seen in a global asset like this one. However, what I do with any kind of asset is again pretty easy. I buy during small pullbacks, deep pullbacks, or big crashes. I buy at periodic moments on a weekly basis, and I just adjust my interest size based on how deep the pullback is. This way, you get cheap prices during bargain moments, and your potential profit can be much greater than buying something at all-time highs. It's a very simple idea actually, but it is quite effective as well. Now let's get back to the Bitcoin and do a little analysis on it, so we can talk about what we can do going forward. In this weekly chart, especially if you look at the price cluster around 70k, this is one of the biggest demand areas for the Bitcoin in the future. It also happens to be a great SR flip location to hold the price as a support area. We can also think about this small liquidity point or points as an extra factor as inducement. So, if the prices crash here, which is a high possibility, this would be a best areas for me to buy Bitcoin heavily. If I can see a structure shift in this area, it will be great for the next rally to break all-time highs in the future. However, why did I call this weekly imbalance the most important imbalance area beforehand couple of months ago? Also, this area was the 100k round number location, which I care a lot. So in the future, for an early rally, we needed to break through this imbalance and also break through this 100k level, because this would be a great opportunity for an early rally to make another all-time highs. This is why I said watch this imbalance and wait the reaction. However, my main concern was this multi-level imbalance area. If you look at the 1, 2, 3, and 4 weekly charts, at the same time, once the price hits the multi-imbalance area, it struggled a lot. It was also making these swing failure patterns in this location. So this crash was inevitable if you look at the multiple charts across different time frames. So, do I keep buying Bitcoin? Actually, yes, I do. I buy in very small amounts at the moment. It's just strategic positions, and I adjust my position sizes the way I teach in the Swing Investing Masterclass with working agents. These investments are for the future, not for immediate profits. So, the lesson of today is simple. No one in the world, including me, and I mean no one, can predict the future. We just do not know. We do not know what will happen in the next hour as well. This is why we avoid expensive prices at all-time highs. This is why we make small and periodic entries possibly every week during pullback periods. Finally, we never put all our money in a single asset like Bitcoin. There is gold, stock markets, real estate, and great other opportunities globally to invest all together at the same time. Let's talk about great setup, clean executions, and smart position management. But sometimes, no matter what you do, things just don't work out the way you expect them to do. If you look at this chart, you can clearly see a great trade location right here. It is a multi-imbalance level combined with a strong support and resistance flip location. Now, as you can see, price rejected these levels twice as a resistance. However, later on, this same area was broken very strongly with a lot of momentum. Normally, I would expect the price to find support in this area after the breakout. And then I would expect it to continue pushing higher from there. So, why do we take this kind of trades in the first place? Because we see this pattern forming again and again and again in all asset classes, and we keep repeating the same pattern over and over to build a statistical edge across probably 100 trades. Sometimes it works out perfectly. Sometimes it fails and doesn't follow through. But in the long run, we are simply trying to gain a small advantage over the large number of trades. Now let's drop down to the 5-minute chart and talk more about the entry location. When I look at this chart, what I see is structure shifts happening on the lower time frames. Also, I see this inner triple equal high sitting there as a clear target. So my natural reaction would be this. With this inner trend and structure shift, we could have at least ridden the price move up toward those triple equal highs above. What we are trying to do here is build a tight and clean setup around that idea. And this is the right mindset to have when we are approaching this type of trades. As you can see, we almost reached a 1.5R gain, which means a solid profit on the trade. But the asset simply did not have enough strength or momentum to fully complete the move up to those triple equal highs. What you are seeing here is basically an inner power of 3 or PO3 playing out. You have your target clearly defined and you have your internal structure shift. So altogether, this is just accumulation phase, manipulation phase, and expansion phase of the PO3 model. In this specific example, it did not fully play out, and setup ended up failing. But that does not mean you were right or wrong as a trader. It simply means that this time, the setup just didn't work. In your trading journey, no matter what strategy you decided to use, this will keep happening. It doesn't matter if you trade trends, RSI, pure price action, or smart money concepts, or just order blocks. Your strategy will fail time to time and nothing can stop it. You have to be mentally prepared for failing setups because you are going to lose trades. That is just a harsh reality and the nature of trading. Let's take a look at a couple of clean price action moves that happened recently and use them to sharpen our trading skills. If you happen to look at the Solana chart, you probably noticed this very clear previous day low area. But even before that, we had this multi-imbalance zone combined with 2 hours supply order block above, along with a clean support and resistance flip level. So as a typical price action trader, this specific area should have stood out as the most optimal trade location. If I had been looking at this chart a bit earlier, I would have expected this exact type of movement to happen. Then if I noticed the market structure shift followed by a couple of breakout structure moves, this could have been a great opportunity to take a few short trades here. As you can see, identifying tradable areas and looking for entry opportunities really isn't that complicated. It just takes patience and discipline. Most of the time, it simply comes down to waiting for the right moment to act. However, in this case, something unexpected happened in the market. After the internal swing failure pattern, the structure dropped hard and took out the previous day low much earlier than expected. So now let's break that down. Then, right after the swing failure pattern from the 2-hour charts, what formed next was this very clean and perfect equal low setup. Okay, let me remind myself again here what really happened in this situation with you. Normally, I would expect price to keep pushing higher and higher until it reaches the order block area. But this time, that expected move did not happen at all. What actually happened here was a swing failure pattern followed by an internal structure break, which then created this very clean equal lows. What I see here is a PDL, meaning the previous day's low, combined with equal lows. And price is very close to taking that level out. So in the end, taking a short trade right after the structure break and a small pullback into this BPR area is not a bad idea at all. Because there is a lot of liquidity waiting below for us, including the institutional liquidity sitting right there. So this is telling me that price is trying to move down right now, and we really should not be fighting against the most current direction. However, if you ask me personally, I would still say the most optimal trade location would be these upper areas to take a short from. So if I were to set a limit order here with just maybe a 0.5R risk, would not be a bad idea either. So if there are two different trade opportunities available, if you see two trades, it is always better to divide your risk into smaller parts and take the multiple entries instead of going on with a one single big position. Let's look at the conflicting trading ideas and go through some clues on how to avoid taking bad trades. When I was looking at the Solana chart with this multi-imbalance area, I honestly thought this was a great possible location to look for longs. And it wasn't just that either. There were also three very clear and identical swing failure patterns on the chart. So overall, this looked like a great spot where the buyers could potentially step in again and ignite a second leg of the rally right here. Now let's drop down to the 5-minute chart and talk through this setup in more detail. This is the multi-price action location that we just identified on the hourly charts. When I first saw this, I noticed this internal market structure break followed right away by this inner imbalance area. And this was a solid 2-hour trade setup. At first, this trade actually looked like it was working really well and even reached 1-hour profit during the move. However, by the end of the day, this trade failed pretty badly. Even though we had what looked like a high quality setup here, we missed something important, and that's we really need to think about and question right now. Now, when I was looking at this chart from a different perspective, I also noticed that the previous day's high had already been hunted. However, on that previous day, the high did not really act as a strong support area at all. So what happened here is that the buyers simply did not have enough strength or momentum to push this price even higher. Instead, what we got was a clear counter market structure break right after the previous day high was hunted. And that alone already gives us an idea of a potential short trade opportunity here. But we actually took a long trade instead. So sometimes it can be really hard to avoid this kind of conflicting trade ideas, and it is human nature to miss things and make mistakes. So do not worry about this kind of mistakes in your trading career. Okay, what I want to say here is that institutional levels like the previous day's high and low or the week's high and low can sometimes be very tricky areas to trade around. As you already know, we normally expect price to hunt these levels, especially when the price is trading very close to these zones. However, once that area gets hunted and liquidity is swept, there are usually two possible outcomes that can follow. First of all, in many cases, these institutional levels can act as a strong support or resistance areas, and the obvious trend may simply continue in the same direction. That is exactly what I expected to happen on the Solana chart we just analyzed together. However, many other times we see a very clear market structure break after those liquidity levels get hunted. And that break of structure is usually followed by full trend shift where the direction completely changes at all. So imbalances and liquidity alone are not enough to build the high probability trade ideas. You also need to clearly follow and carefully analyze the overall market structure if you want the best possible trade setups. Recent price action in cryptocurrencies, especially the big drops in the major coins, is giving us some really solid short opportunities right now. And thanks to our ICT high time frame candles indicator, we are able to clearly spot some very usable and high probability trade areas. For example, in this case, Ethereum had this amazing multi-imbalanced area that was perfect to start looking for trades. And that area was also combined with multiple swing failure patterns lining up together. So by using our indicator, we quickly identified this zone, and then we used the price action concept called the swing failure pattern to further confirm and fine-tune our great entry areas. Now, when you drop down to the lower time frames like 5 or 15-minute charts, you can see the price action much more clearly and really understand what is going on behind the scenes. First of all, notice how the SR flip point works beautifully in this example. And it's not just a simple support and resistance flip, because it also lines up with the previous day's low area that is pushing the price level. This is kind of a masterclass amplifier. So when we zoom out and look at the big picture, what we have on the higher time frame is multiple imbalances combined with the multiple swing failure patterns stacking together. And on the lower time frames, you can clearly see a strong and significant SR flip aligns perfectly with the previous day's low. Now, this is what I personally call a magnificent A++ price action setup that we can consistently find by using our indicator. And the next question is how we should actually treat this kind of setup in a real trading situation. Of course, the next step is to look closely at the lower time frame structure and see what is really telling us. As you already know, trend reversals on the lower time frames usually begin with a clear market structure break, the MSB. After that, you should also ask yourself where the price is most likely heading next. And this bottom, especially when it forms in a parabolic way, we can push the price into certain areas that could become great targets for us. Now, what usually happens after the first market structure break is the trend continues and becomes more dominant by making a second break of structure. At that point, you're basically looking at a strong, clear downtrend. And in that area, you can often find the nice imbalances and small zones that give you solid scalping entries on the 1 minute, 5 minute, or even 15-minute time frames. Now, the most common entry is getting on the market structure break combined with the inner imbalance. A nice 2-hour setup in this situation can be very clean and very attractive, as you can see. However, the problem is that market structure breaks, the MSP, can be fake many times because shifting a trend and changing the structure in the opposite direction with a first MSP is not an easy task all the time. So, if you find yourself getting stopped out again and again and again by trading on the microstructure breaks, that usually means you should wait for the dominant trend to form first. And the first sign of a more dominant trend is seeing a second break of structure after the initial MSP, the market structure break. So sometimes it is actually smarter to skip the first trade and join the trend later with additional structure breaks like in this example, which are usually much stronger and more reliable. We are going through some very interesting days right now, with prices moving up and down again and again. During this time, I received a question about IFVGs, which are basically known as inversion fair value gaps or inversion imbalances. So first, let's take a look at the Solana chart on the higher time frames. We have this very clean SR flip location sitting just below the $90 level. As you can see on the chart, price keeps rejecting this area over and over again. But later on, this level finally gets broken extremely fast and very strongly. What happens here is a classic support and resistance flip, where the previous resistance now turns into a support area. And when you combine these concepts with a multi-imbalance locations, you start getting a very strong potential entry location. If you look close to the candles here, you can clearly see that alt high gets broken and creates a masterclass price switch. So if you're a lazy trader, can you build up a setup like this, just 1-to-1 ratio position using only a 2-hour time frame, a single high time frame? Yes, that is definitely possible. It might not give you the huge profits, but it's a solid way to enter a trade for traders who don't want to do extremely deep analysis. But what happens if we drop down to the lower time frames and continue the discussion from there? When you open the lower time frames like the 5-minute or 15-minute charts, you will notice that price is crushing hard into our SR flip location. This clearly shows a strong downtrend forming on the chart. But I want you to focus for a moment on this large fair value gap area, the imbalance right here. The definition and the real job of a fair value gaps and imbalances to push the trends in their current direction. So with this fair value gap and imbalance in place, this trend should normally have continued moving lower and lower. But what actually happens here is something completely different. That fair value gap failed and it eventually turned into an inversion fair value gap. By nature, fair value gaps behave very similar to SR flips in the market. When a fair value gap fails, they can turn into inversion fair value gaps. It works the same way that a resistance can turn into a support. So basically a flip happens. And this is the basic idea behind trading inversion fair value gaps. Now when you look at the setup here, you can see that's a 2-to-1 risk-reward ratio setup. If you compare this to the higher time frame setup we just looked at earlier, that was 1-to-1 ratio. But this time using higher and lower time frames together can often give you a much better probability when you are trading. But the way you trade will always depend on your own availability and how much free time do you have. At the end of the day, how you trade is your choice, and it depends on your lifestyle. Today, let's talk about when to look for shorts and when to look for longs and how to decide what to do when we are staring at the chart in real time. As you already know, price likes to move towards specific levels on the chart. This can be things like the institutional liquidity, the previous day's high, or maybe equal highs or lows that act as clear liquidity levels. But just knowing those levels exist is not enough to actually take a trade. You should always look at the inner structure of the market to understand the current direction and momentum. For example, in this chart, at a certain point, the inner structure is clearly bullish and pushing towards the previous day's high point. The next question you should ask yourself is simple. Should you be looking to short this move, or should you be looking to long this move? The logical answer is to always follow the inner structure and trade in the direction it is showing you. So in this case, taking a long position makes the most sense because the structure is bullish. But what happens once price reaches and hunts that institutional level? What should we be thinking about that point? We still need to look for additional clues from the price action before making another decision. For example, is the price getting rejected from that level? Maybe forming something like a swing failure pattern. Another important thing to check is whether the structure has changed and the inner trend has now turned bearish. If the momentum shifts and the inner structure flips to bearish, then taking a short and following that new momentum becomes the better idea now. So basically, this is how you read the clues the market is giving you and use them to guide your trading decisions. Let's take a look at this specific example at Bitcoin that happened just a couple of days ago. What you will notice here is that we have the previous day's high, combined with equal highs sitting above it, and a very clear price action. If you look at the internal structure, it keeps making new higher highs in the same direction. So, what should I be doing here? The logical idea would be to follow the current move in that direction and look for a long trade here. But what happens next? Maybe the trend continues and the previous day's high turns into a support for even more long positions. We do not know that. But in this case, price actually rejects the previous day's high level with a swing failure pattern. Then we see the internal structure shift that starts turning the bearish. So in the end, it makes more sense to look for short positions rather than trying to force longs here. You see, this is how we combine small clues together using liquidity, structure, and some imbalances to make smart trading decisions. So, if you are looking at any charts right now, should you be looking for the longs or should you be looking for the shorts? When it comes to longs, if you notice that the internal trend structure is clearly bullish, that is usually really a strong clue. Then you want to ask yourself, is the price moving towards a major liquidity like the previous week's high or set of equal highs? Then another small clue is when the imbalances are bullish and actually supporting the overall trend in the direction. That's basically how you should be looking and thinking about long trades in the market. Now, what about looking for the shorts instead? Okay, let's say price has reached a major level and that area is now being respected. Then you need to ask this, is the price is getting heavily rejected at that level with a large wicks or even swing failure patterns forming? But even that alone is not enough to jump into a short trade yet, because the trend could continue pushing higher and higher for a long time and we just do not know that yet. What you really need to do next is look for a change in the internal trend structure. If the internal trend turns bearish and starts making new lower lows, that is an important shift. And that's when it becomes a much better time to start looking for short opportunities. So, these are the small clues that you want to pay attention to before trading any asset on the market. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free TradingView indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.